Well, hello, it's Richard Pears from FinextraTV, and I'm joined today by Louise Pryor. What we're talking about today is that at the heart of the allocation of capital, a lot of what we heard about at COP is how does this money actually get to the projects in the field. But at the heart of that is often risk and the pricing of risk and the risk allocations. Sandy Trust, who we know, Director of Sustainable Finance at EY and also Chair of the Institute and Faculty of Actuaries Sustainability Board, said the fundamental question for actuaries and their employees and their clients is whether or not they're pricing risk correctly. And if they don't include climate change in their modelling, they're missing a trick. So today, as I said, I'm delighted to be joined by Louise Pryor. She's president of, that said, IFoA. She's the chair of the London Climate Change Partnership and director of the Ecology Building Society. Welcome.
Thank you. Good to be here.
Well, the question is, for many people perhaps, what is an actuary and what is the role in climate change?
Well, indeed. So actuaries are, I guess, the sort of mathematicians behind a lot of insurance. That's one way to look at it. So what we do is we look at risk, especially long-term risk, and we look at its financial effects. So you get actuaries doing pension schemes, for example, where you've got, contributions now to pay benefits later. There's risk, financial risk in that, long-term financial risk. You have actuaries in life insurance, which is actually where they started, that you pay a regular premium now, and then when you die, money comes in. Well, how does that all work? And you get actuaries in other insurance too. What exactly is the risk of your house burning down or whatever? But I mean, there's a lot of other more complicated risks, and increasingly you're getting actuaries in other areas as well. Anywhere where long-term risk matters, they're in the investment industry quite a lot now, spreading out into banking. So just sort of mathematical people with an eye on risk, focus on risk, and the sort of business effects of it.
So that's really interesting. As we know, a lot of people are just implementing the calculations of many others. So if you're the calculators, what does that mean to climate change then? You said across all of insurance and banking and investment. So I guess we can figure it out, but you tell us what it means.
Well, what it means is there's two things. One is that actuaries, they make very few sort of final decisions on things like insurance premiums and things, but their calculations are a major factor in that. And so they have to think about the effect that climate change is having on the risk. So especially in the long term, how is climate change going to affect investment returns, for example? And that's a really big deal because we know that if climate change is allowed to continue unfettered, that we're going to get major financial and economic effects. If climate change is mitigated, so it doesn't happen, we're then going to get major effects from the transition to a low carbon economy. So either way, things aren't going to continue in the same way. So actuaries have to think about how they might be different, what the range of possibilities is. We don't look for the most likely outcome. We look at the whole range and think how you can cope with the whole range. So what climate risk is doing is effectively changing what that whole range is. So actuaries, we're having to develop new techniques and think of new ways of dealing with it.
So we often talk about, risk as, the analogy of a car. You're looking in the rear view mirror at what's happened historically. The rear view mirror is sometimes considered to be the smallest view in the car. And really what you need to do is think like a Tesla and, use some radar to predict into the future to see where the car crash are coming from. If you get the thread, it's basically saying, do you need to change techniques? Because obviously climate change is unfolding faster and more frequently and more intensively than the historical models will perhaps have told us.
Yeah, this is really difficult because the risks due to climate change aren't like the risks that actuaries usually deal with. We usually deal with risks that are repeatable. I mean, not obviously individually, people don't die a lot, but, you know, lots and lots of people die over and over again. So you've got a huge you've got a lot of data on the numbers of people that die. You've got a lot of data on for motor insurance, for home insurance, all those things. The risks due to climate change only happen once. Climate change isn't going to happen over and over again. It's a single time and it's chronic. It's taking a long time to happen. So we don't have past data about how climate change has what it's done thousands and millions of times in the past. It's just a one-time thing that's really changing the world rather than just being one incident. So it's, if you think about it, if you've got a whole collection of points and they're moving and you've got a lot of points all like that, it's quite easy to think about what's going on in the middle of all those points. That's interpolation in mathematical terms. If you've got a whole collection of points and you want to find out what's going up there in the future, you have to do what's called extrapolation, and that's a lot more difficult and it's a lot more uncertain. So we're basically having to think of ways where we can use data on what's happened so far, what the effects have been so far, and think about how that might, all the possible ways it might play out in the future.
Right. And so do you just, you know, on that, do you see, you know, is there other sort of working groups and, you know, various other bodies coming together to sort of do a root and branch analysis of the way that you're going to actually tackle this? How can we sort of see what's happening and therefore what might change in terms of, you know, the process and therefore the calculations?
I think it's a gradual process because a lot of actuaries are actually having to address this problem every day in their working lives. I mean, all the actuaries who, for example, insure or work on the pricing, say, for natural perils like bushfires, for example. So take bushfires in Australia. I mean, we all know that there have been many, many more of them than there were in the past. So actuaries are gradually getting an idea of how that's changing and are building it into their pricing. So, you know, these are, it's a very sort of incremental feeling our way forward about how things are happening. And yes, there are a lot of very smart people thinking about it.
So this is the role of sort of technology and data comes in here, I suppose. You know, we work with a lot of companies who are using not only historical data from, you know, ice cores and observations which have been done all around the world for years, but also obviously more modern satellite and sensor techniques, which allow you to look at Earth systems, see temperature change, see the relationship on Earth systems. You're saying that's the sort of techniques and data that are coming into the models of the actuarial profession to help calculate risk?
Yeah, certainly I think they're using a lot of that sort of data in the modelling of the physical effects. But one of the big areas that nobody really knows is how that then translates into the financial and economic effects.
Right, and so that's the physical risk which we're seeing, which, and then you've got to overlay on that, you know, assets, legal ownership, security, and then into portfolio and so forth.
And I mean, so much is going to change. So just to take a simple, well, not a simple example, an all-encompassing example, nearly every value chain in the world is based on energy.
Yeah. Yeah.
That's good. So nearly every value chain is going to change.
Well, and everyone is based on nature to a large extent.
Yeah, exactly. So they're all going to change. That means all the business models are going to have to change or may change. Some of them won't, but a lot of them will, which means that the insurance needs of all those organizations using all those business models are going to change. So, you know, one thing that we really need to do, or the insurance industry in particular needs to do, is to think about how it can design its products to take advantage of the new, because there's always challenges and opportunities. So presumably there's new insurance products they can write that will turn them a profit, but will also help people navigate this changing risk landscape. But also, how can they design their products to encourage people, to support people, to facilitate the change to the low carbon economy that we need? to incentivize. How can insurance be used to incentivize? And also, especially, I think it's also important to incentivize adaptation, because whatever we do, however good we are at reducing our emissions, we still have some climate change happening, and we have to adapt to that too.
Well, and of course you're involved in the director of the Ecology Building Society, and let's sort of ground this in a real world example for people. So there was a lovely story in the BBC, or terrible story in the BBC, depends on your point of view, of somebody who's built a house on ecological principles. It's all signed off by building controls. It's nothing weird and wonderful. It's just different. And then they go to get to an equity release scheme. And the people that calculate the risk probably at those firms have said, don't recognise this. Here's a very heavy, price, which is obviously not acceptable to the house owner. So we're in a bit of a chicken and egg situation, aren't we? If we want to give those people the incentive to build the new ways forward, this is a house, it could be a massive solar plant. How do we get the chicken and egg resolved?
I'd say through niche players like the Ecology. I mean, that's absolutely what we're trying to do at the Ecology. Is we do mortgages on modern methods of construction. We absolutely support low energy houses, both in the construction methods and in the then use of the house afterwards. But there are even at the first mortgage stage, there are very few banks and building societies that do give mortgages that allow for those sorts of things, because most mortgage providers are, if you like, they deal in mortgages as a commodity. So it's a big, there's lots of them go across their desks and they don't really pay much attention to each one. So that my mortgages on buildings that are, if you like, minority buildings, that aren't like the majority buildings, they're not the traditional sort of mass production techniques. Those mass production mortgage evaluators don't know how to cope with the small numbers of new and emerging techniques. We do at the Ecology. So what you've got here in the equity release is things are provided by insurance companies, which are, even if you like, one step further removed, because they don't do the first mortgages, or certainly not to the extent that the banks and building societies do. So to find an insurance company that has the expertise in the new and developing construction techniques is I don't think it's going to happen. Now, it should be happening. This is exactly the sort of thing that the insurance industry has got to do. They have absolutely, because that is exactly the kind of example of a product that would incentivize and support the use of the construction techniques that we need so badly.
Absolutely. So you're giving the first mortgage. You need to team up with an insurance provider that's got a great product, and then the person that was in the BBC article can build their house and get their equity release, and that's a great incentive, as you say.
Yeah.
So when we talk about tipping points in nature, but what about tipping points in the financial services industry? It seems like you're targeting insurance, but insurance, reinsurers, asset owners, asset managers, who goes first? Because they all seem to say, well, they can do it first and then I'll follow. Who goes first?
And don't leave the banks out of this. The banks actually are really important.
Yeah.
People talk a lot about investment and they talk about divestment, but and I mean, divestment is the sort of do no harm thing, except that it possibly does do harm because of the lack of engagement and so on. But if you want to think about what your money's doing and what good it's doing, you have to, I think, equities are important, but they're a secondary market. Okay, if you buy equity shares in a company, that doesn't actually help that company directly at all. It might make it easier for them to raise new capital, but it doesn't, particularly finance anything in particular. So it's the bonds and the lending that you have to think about that really have the direct or the more direct impact. So I think all investment owners have to think about that. They have to think about the actual impact their investments are having. Banks in particular really need to think about what sort of projects they finance. You know, is if you go to a 4 or 5 degree world, it has famously been said by an insurance CEO that a 4 degree world is uninsurable. Now, I don't know that everyone agrees with the details of that, but the concept is that if we let climate change continue unfettered, the world is going to change so much that the insurance industry as we know it is not going to exist. Yeah. The question is, should insurers then be insuring things, if you like, enabling things to happen that will make their industry not exist 20 or 30 years in the future? If you put it like that, the answer seems quite simple to me.
Do you think those short-term method is, you know, well, I can keep putting the premium up every year, I can offset it to the reinsurance industry, government is insurer of last resort, I'm only here for 5 years as a CEO, doesn't really matter to me. Is that the attitude?
Yeah, of course it is. But the same is true of banks. What would banking be like in a 4 degree world or a 5 degree world? No one's really addressed. I mean, I'm not an expert in that, but are banks doing the same? And banks have a much shorter term view anyway, because it's essentially a shorter term industry than insurance is. And are they doing the same? Are they supporting projects that will put them out of business?
Absolutely, yeah. So last sort of question then, why should we be hopeful? Because we know all the dynamics. What needs to change? The government sort of probably didn't really do a great job at COP, although, you know, the optics sometimes different from the on the ground reality. Why should people get engaged? Why not just go and sort of, you know, spend your pension down the pub?
Because everybody can make a difference. We can all make it less bad than it would otherwise be. And some people, especially the corporates, can make it a lot less bad. Essentially, if the corporates put their weight behind it, they can have a lot of direct effect. I mean, you and I, Richard, we can, you know, stop flying as much and that sort of thing, and that has a very minor effect. If a corporate really does go net zero properly, rather than just through offsets, goes off net zero by reducing its emissions, that can actually, you know, that's a much bigger effect. But also it changes society. What has to happen is society has to change, and if society changes enough, that will then drag the governments, possibly kicking and screaming, behind us. So what we all need to do is to keep up our action and keep talking about it. Treat it as normal to be worried about, well, worried sounds a bit negative, to be concerned about this. Treat it as normal to think that it's important and we can all do something, so that, you know, so that then the government simply can't ignore it.
Absolutely. And in the role of as an actuary, got to speed up the change to sort of, you know, this climate risk, this adaptation pricing, so that there's this incentive model for active and concerned people to actually be able to do the brave new world, and then many other people can follow.
Yeah, and actuaries, how we can especially help is by speaking up about the risks, is by when people say, oh, you're just doom mongering, you say, yes, that's our job as actuaries, not to doom monger as such, but to point out the full range of possible outcomes.
Perfect. Well, what a point to leave that on. Thank you, Louise. It's been interesting, passionate person that you are to talk to. Thanks for your time.
Thank you, Richard.